The next few lessons, including this one, are going to be extremely important. This is something that not a lot of people understand or even know about. Market context is a very key component in not only my trading strategy, but in any other strategy or any other tool that you use. Market context essentially helps you gauge the current story that the market's telling you. I always refer to this analogy as the market being a storyteller. It's reading us a book constantly, and it's up to us to determine the story that it's reading. We can determine the story by reading its context clues. Remember back when you were younger, maybe kindergarten, when you were first, learning how to read, and you were trying to comprehend the book, and the teacher would always say, if you don't know a word, put context clues together. It's the same thing with the market. The market's going to spit different things at us. We might not be able to understand it or see what's going on. However, we have to put the context clues together to determine and give us a good idea of that story that it's reading us as a storyteller. Now, these context clues essentially gauge the relationship between buyers and sellers. You all know the market is an auction place, it facilitates trade. So these context clues give us a good sense of direction in the auction place between buyers and sellers, and it'll help us understand the constant tug of war battle between participants. Buyers are always fighting sellers, sellers are always fighting buyers. When we're trading, we want to be long when buyers are winning the battle, and we want to be short when sellers are winning the battle. So we have to put these clues together, gauge the relationship, and we could take trades on the same side as the stronger participants. Now, the reason why nobody talks about market context, it doesn't come up in books, it doesn't come up in any other lessons that you may learn, is because it's not something that you're going to fully understand and learn until you do it yourself and you observe and watch the market. This is not something you could learn from or read from a book. This isn't something that you're going to fully understand even from these next few lessons. However, I'm going to give you the guidelines that what I look out for and what I use, and how I see the market may be different from how you see the market. My context might be different than yours. Yours might be different than mine. There's no right answers in this. It's just how you see it versus how I see it. And we all take trades, or you take your own trades, based off of the analysis that's going on and the thoughts that are going through your head. So keep in mind, you're not going to understand this. The best way to shorten the learning curve is going through these next few lessons, also going through the recaps, also just observing and watching the market. And I also want to mention that all the examples in these sections, all are going to have to do with the S&P 500. It'll be very simple for me to explain it with the S&P versus looking for setups on other equities. This is relevant for any market, any stock. It does not matter. The clues are going to be the same. However, just to simplify these examples and show you clean price action without scanning for 100 different setups, all the following examples in the context section are going to be on the S&P 500. The first lesson we're going to go through in depth in this lesson specifically is the bigger picture analysis. We're going to be looking at higher time frames. A lot of traders look through a microscope when trading. They don't understand the bigger picture, looking at multiple higher time frames that will coincide with their smaller time frame analysis. We're also going to go over in a different lesson, new buying versus new selling. We're going to put ourselves in the competition's position, understand where they're trading at. We're also going to go over news and volatility, volume, which is a little different than volatility. We're also going to break down balanced versus imbalanced markets, along with some past pre-market plans, just to gauge my context. So maybe you could reverse engineer where my levels came from, reverse engineer where I was, how I was reading the market to further expand your knowledge to come up with your own context. But let's first go over the higher time frame analysis. Look at the bigger picture. This is very key because it happens to me all the time as well. Sometimes we get too fixated on what the smaller time frames are telling us, and it might be a little different than what the higher time frames are telling us. But first we have to understand, which is kind of common sense, when supply exceeds demand, price is going to move down. If you have a surplus of something and you don't have enough buyers to fulfill that surplus, the sellers or the supply are going to make price move down just to attract more participants at a lower price, where the demand and supply equilibrium will become balanced. Then we also have demand exceeding supply, and this is when price moves up. If we have a lot of people that want to buy something, kind of seeing it right now in 2021 with the real estate market, there's a lot of demand out there and there's not a lot of supply of home prices. So what that's going to do is it's going to drive the price up because there's not a lot of people selling something to meet that demand. So that's just essentially the basics to it. However, in strong uptrend markets, we have higher highs and higher lows. Just like this example, we move up, we have strong demand as price is moving up, we pull back, and we create a low before moving back higher. Same thing as the cycle repeats, we create higher highs and we create higher lows. It's a very strong uptrend. Same thing on the flip side. Strong downtrends have lower highs because supply is stronger. We move down, we create a low, we temporarily bounce, and the high after that bounce, this little rally gets sold into, and the market moves down. It's kind of common sense again, but this is just the basics to what I'm going to get into. This could be on any time frame. It depends on the story you're looking to interpret to get context. For me, if I'm trading off a 1 minute or a 5 minute, I want to be looking at least on a 15 minute, guaranteed a 30 minute, even an hour, 2 hour, 4 hour. It does not matter. The higher the time frame our analysis comes into, the better off we're going to be. And some time frames are going to tell you a little bit of a different story, but it's all relevant and it's all you just putting the pieces together. So here's an example of an uptrend on a chart. As you can see, let me get my laser pointer here. Look at my pen. We create a high here, the market pulls back down, and we get more demand. How do we know demand exceeds supply? This is a little different than a demand imbalance. I'm just talking about demand, meaning price is moving up, is because since we are moving up, we have more willing buyers to buy at a higher price. We come up and we make a higher high. Price then pulls back down. We create a low over here. This is higher than the previous low. The market moves back up. We create a high, we pull back, so we could keep doing this all day long, but this is what a strong uptrend looks like. Now, strong downtrend. We create a high here. We come back down, we move back up. This high is lower than the previous high. This low is lower than the previous, lower than the previous, lower than the previous, and the cycle continues. So this will be the first kind of clue, or the first thing that I look at to gauge the overall bigger picture is, are we in an uptrend or are we in a downtrend? Now, this is relevant because in uptrends, supply zones are going to do a few things. The first one is it's going to be a minor pullback before bouncing up. Picture you if you had a long position, right? We're long at, let's just call it $100. If we have a supply zone at $105, we're going to look to take profits at an area that we have an existing supply imbalance. Or we're going to slice through the supply zone if the demand is stronger than the supply at an existing supply imbalance. Now, in uptrend markets, buying pullbacks into demand are going to be your highest quality of setups. In strong uptrends, I love buying pullbacks that get bought up with buying confirmation inside of demand. Those are the best trades that I take. Those are the ones that make me the most amount of money. So going back to Thinkorswim here. So here we have that same uptrend as before. We can mark out 100 different zones, but just to simplify this example, here we have a 2-hour rally, base, and drop supply zone. We would draw it out from the open of the green basing candle to the top of the wick. We can also extend it if you want, just to get a better idea. Keep in mind, we're making higher highs. We're also making higher lows. We also put in a higher low, which we're going to get into that. And the market forms supply. We pull back down and we start rallying. Now look what happens here. We slice through the supply zone like it's not even there. It's normal. It happens. That's why we wait for proper confirmation to sell the market inside of a supply imbalance. Also, keep in mind we're in an uptrend and the market blew right past it. So one thing that I do want to note here is we do pull back into multiple different demand imbalances. So not only do we have a 1 hour, we have a basing candle right here, followed by a very strong rally to the upside. So we would draw to the open of the basing to the bottom of the wick. Keep in mind, in an uptrend, act like this is a green demand box. We pull back into demand after the buyers over here slice through that supply zone, telling me buyers were very strong. Also, I'm sure it looks better on a different time frame, but we also have a drop, a base, and a rally. We come back, we pull back into the demand zone, and we start rallying. We're in an uptrend. It's almost like a staircase. Doesn't happen picture perfect all the time. However, we move up, we pull back down into demand. We move up, we pull back down into demand. Move up, we pull back into demand. So it's just different areas. I'll make these boxes green just so you could understand it, see a little better. But what I've noticed throughout the years is it's like a staircase. We move up in an uptrend. We want those pullbacks into demand to get bought up by buyers, and we could look to take the market long. If it slices through supply, like that example I just showed you, it's telling me buyers are stronger than the existing sellers at that area. And let's just talk hypothetically here. Let's say this is a supply. Let's go back to that supply example. So we'll mark this out as a supply zone. Let's just say supply formed there. We pulled back into this area of demand. Let me make this green just so you all could reference it. So we pull back into demand. Let's just say we got long. I don't know. If we go to a smaller time frame, it'll look much cleaner. Keep in mind, I'm on a 2 hour. Let's just say we get long right there, right? If we're long, we're going to look to take profit most likely if you're a bigger trader. Once we come into a supply zone, just because we know this is an area already that's existing with a large amount of selling. So usually if we didn't slice through it, let's just act like, we sold off from this. We started moving down. If we were long here, we would look to take profit. And most likely if we took profit, the market would start coming back down and rejecting that supply zone. As if we were to take profit, we would have to sell at a supply imbalance and the market would move down. So usually supply zones in strong uptrends will either slice through like this example, or it will serve as an area of a minor pullback before bouncing back up, because that minor pullback area is just a zone where the market will look to take profits from already existing long position. Now, I don't want that to deter you from taking the market short in strong uptrends. I still take good trades, bearish trades in uptrend markets. However, I'm quicker. I'm looking at them more as scalps versus trend trades. Same thing on the flip side. If we have a downtrend, it doesn't mean to not take the market long. Sometimes I take very good long trades if the market is trending down on a higher time frame. Again, there's no right answer. This is just to gauge the larger and the bigger picture that the market's telling us. Does not mean we can't make money in different markets. So in downtrends, demand zones on the flip side now are going to be areas that price temporarily bounces for, so sellers can look to cover and take profit, or obviously we're going to slice through it if sellers are very strong. And in downtrends, selling rallies or selling the bounces. So if you ever hear me talk about I want to see a rally fail, or I want to see a rally get sold into, that's essentially a bounce up in the market. Something like this. Market moves down, we bounce up, and this bounce up right here gets sold into, especially at a supply zone, and we move back down. And this is where we're going to look to take the market, short in this area right there, or wherever we get valid confirmation. So going back to Thinkorswim, here we have our downtrend, and this is kind of a lot to digest and a lot to get into, but we're going to stick on a 1 hour time frame as it's just going to be simple. So here we have a 1 hour basing and a very aggressive drop to the downside. We are making lower lows. We also are putting in lower highs. So it's an obvious downtrend. The market does rally up and we start selling off from this zone. If we extend this area, this not only rejected once, it also rejected twice for a sell-off. Now, not only did we reject on Tuesday from this sell-off, this drop right here before the close on Monday, if we were to remove this, created supply from that already existing imbalance. And what I've noticed is once we create supply from an old existing supply zone, it's a very key and strong imbalance that we can look to take better trades off of. Same thing for demand. If we create demand from demand, that new demand zone is going to be a very key area that buyers need to defend. So in this case, we sold off, we moved back up. This rally got sold into, especially that it was supply created from supply, and we sold off. Now, talking not only from a supply perspective, but from a demand perspective, this is what I mean about these are just areas that sellers look to take profit. So this is a 1 hour demand zone. You can mark it out like this. Okay, so keep in mind that supply zone, we rejected that supply. The market moves back down. It's a 1 hour rally, base rally, beautiful rally. The market pulls back. And this is a perfect example. You could get long on downtrends at demand, and we did bounce from here. Now, was it an amazing trend bounce? No, but it was good for like 30 or 40 points to the upside. And 30 or 40 points, if you were targeting, let's just say supply, would have been a beautiful, beautiful trade and a beautiful sell-off. So don't limit yourself to only shorting downtrends. You could also long in downtrends, and don't limit yourself from only longing in uptrends, as shorting supply in uptrends will also play out. So always look at if we are in an uptrend, are we in a downtrend, and understand the context, backing that. Now, another one that we have to go into is a higher high or a double bottom. Now, when we have a higher high or a double bottom, it essentially means we have weak sellers or we have strong buyers. So go back here. When we have a lower high or a double top, we either have weak buying as the market couldn't move back up. For example, we could come up here, we create a high, the market moves down, we come back up, and we form a lower high, and the market moves back down. So a high here, a lower high. So that's telling me two things. Either buyers were weak right here, that they couldn't move it back up, or sellers were strong enough to bring the market down. Same thing on the flip side. Let me remove this. Now, if we have a higher low, the market moves down, we bounce, then we come back down and bounce again. This puts in a low. This also puts in a higher low or double bottom, and the market does bounce. we either have weak sellers that they couldn't bring us lower than the first low, or we have very strong responsive buying that they have an agenda to push the market higher. Remove this. So buyers at higher lows in a downtrend could potentially indicate a trend change, especially if that higher low, the second bottom, was put in at demand. What I mean by this is the market moves down. Excuse my drawing skills, I'm sorry. The market moves down. Let's just say we consolidate at the lows, we move up, and we come back down and test that area of consolidation at the lows that forms demand. The market bounces at that demand zone and rallies. Not only did we bounce at demand, but we also put in a higher low. And this is probably a very good telltale sign that a trend change could potentially happen. Same thing on the flip side now. If we put in a lower high, it could potentially indicate a trend change, especially if it's at supply. So the market moves up, we consolidate, we rally, we base, and we drop. Maybe a couple days later, we come back up, we retest that consolidation, that basing period that forms supply. We come up and we reject. So not only did we reject supply, but we also put in a lower high at an already existing supply imbalance. This is a very good indication that the market may want to test lower prices. Now also, a failure to stay below a low, excuse my drawing skills, a failure to stay below a low is very bullish, and a failure to stay above a high is very bearish. So these are all going to give you extra indications to go long or short just by gauging the strength of buyers versus sellers in the whole auction process and the whole supplier demand equilibrium. So I'm currently looking at a 90-minute chart, and let's just act like they were smaller time frame. Let's just call it 15 or 30-minute demand down here at the low. We bounced in it overnight. The market moves back up, and we reject this supply zone over here, as you could tell from this upper wick, and we move back down into this demand imbalance that formed yesterday before the close and the one that we bounced at overnight. So a key concept here is we're obviously in a downtrend. If we were to look now from left to right, we're making lower highs. We're also making lower lows. We are rejecting the supply zone, but we do have a lower wick right here, and the market sells off from supply into demand. But one thing I want to note here is look what happens. We put in you could call it a double bottom. It doesn't have to be exact, or you could call it a higher low, especially at demand. We either have weak sellers or we have very strong buyers that have an agenda to push the market up. And as you could tell, this was the start to the trend change that we were just talking about after making higher highs and higher lows. Same thing on the flip side. This is now on a daily chart. We have a rally, we have a basing candle, pretty big basing, followed by a very aggressive drop. So if we were to draw a supply zone like this, the market sells off, moves back up into that supply zone. We put in a lower high at supply, and look at the trend from the next month after that. So beautiful sell off after that, very strong move down, and I'm sure there would have been demand in this area on smaller time frames where we bounced at and the market moved back up. So just play along with this, go along with different stocks, different time frames. Mess around with it, see if you could see different trends, get a good sense of it. I mean, as you can tell here, this was probably demand in this area that we bounced off at. Even in this case over here, I'm sure if we were to look at smaller time frames, we would find it. The market pulls back down, comes back into this area of demand, and then rallies back up. Started a trend over here. Same thing in this area. Let's just call it supply. I don't want to take up too much time with this lesson. We reject the supply zone. We put in a lower high. The market sells off, the following 2 weeks after that. So lower highs at supply, usually on higher time frames, can indicate a trend change, and higher lows at demand on higher time frames could potentially indicate another trend change as well. So now we have wicks, and this is the last thing I want to talk about. This could be bigger picture, this could be smaller picture. It does not matter the time frame. Obviously, the higher the time frame you get, the bigger the wick probably is, and the more development we've seen in the market. However, lower wicks indicate buying pressure because it means the market moved down, then immediately bounced back up, indicating buying pressure came through somewhere in this area. Same thing on the flip side. An upper wick now indicates selling pressure as the market moved up. Some seller was sitting there, was very responsive, did not like prices being this high, and they brought the market down. So for example, we have this lower wick, indicates buying pressure. This upper wick indicates selling pressure. The buy does not really matter to me. It really only matters about the wick because the wick just means price came down and something there did not like it. It was not in agreement. They were responsive and brought it back up. So here's another example with multiple candles, obviously not green or red, but we have a wick over here. So a wick inside a supply is bearish, or a wick in general just indicates, let's see if I can write this out properly. Definitely not. It indicates sellers. A lower wick like this on the downside indicates buyers. So that's another addition to add to your arsenal about context. I love seeing wicks because it tells me buyers or sellers are present at a specific area.